In this chapter, we're going to talk about funds in the company. Have you ever wondered where do companies get money? I mean, when they need a lot of money, how do they do it? Because maybe they have savings, they have profits from previous years and they can use those, but probably they are not enough for everything they need. And what if the company is new? If it's new, where can you get money to create the company? So right now we're going to see some concepts that are related to fundings, and they are going to be important for you to make the exercises. But there's going to be another chapter, and a specific one, and we will talk about funding a little bit deeper. So there are mainly two ways or two types of funding. We have equity and we have liabilities. Equity are funds that belong to the company. They are own funds, owned money. And liabilities is money that you get from the bank or you get from someone else. So usually there has to be some kind of balance between equity and liabilities, but we're not going to talk about this balance right now. We're going to see a little bit deeper which kind of funds are inside equity and which kind of funds are inside liabilities. So according to the origin, we have equity and liabilities. There are other classifications of the funds. So you can have short-term, long-term, and other classifications, but we're not going deeper into that in this video. We're going to focus in the difference between equity and liabilities, and especially we're going to focus in those concepts that you see in red, okay? So why are equity or why is interesting for a company using equity? Well, equity are funds that are free to use and you don't need to return them. And in this category, we include the corporate capital, the social capital of the company, we include savings the company has, we include the profit of that year, and we include grants. And I will explain a little bit deeper these concepts, okay, the ones that are in red. On the other hand, you have liabilities. Liabilities have some limitations to use, and most of the times you have to return them. So they are not so interesting in this sense because there are limitations and you have to return them. And we're specifically going to talk about loans during this video, okay? But we also include in this category trade payables, what you have to pay to your suppliers, and taxes and social security. Okay, so whenever you have to pay taxes or you have to pay social security for your workers, there are special accounts in which you place that money you have to give to the tax office or to the social security department. So the first one, corporate capital cost. We have already talked about this. There's a whole video about it. Okay, you remember what you renounce to earn because you put your money in a company instead of buying shares or buying some bank savings products or whatever. It's an opportunity cost, and what you have to be careful here is that corporate capital itself does not go in the table. What you put in the table is the corporate capital cost, and you calculate it multiplying the corporate capital by a percentage. You already know this, so let's move on to the next. Let's talk about grants now. The first thing is definition. What is a grant? Grant is money that the company gets because they fulfill some requirements and they have to spend that money in what they indicate. Who's giving this money? Well, most of the times it's a public administration who's offering the money. The European Union, the town hall, I don't know, Spanish government, and they say, okay, if you want this money, you have to have these characteristics and you have to do this with the money. So there is what we call a concession sheet. There's a document that says what are the requisites to get the grant and what can you do with it. And after getting it, you have to give some papers and you have to give some proofs that you're using the money in what you said you were going to use it, okay? I think the best way to help you understanding this concept is making it a comparison. Maybe some of you are getting a special grant for studies. Whenever you get a grant for studies, you don't have to pay to the university to come and receive the classes and so on. So in order to get the grant, you have to give some documents and you have to explain why you need that grant. Because we don't have a lot of money in my house, because we're in this financial situation, because I've been studying already for several years and I'm doing it very good. These are my records from previous courses. Okay, so there's someone who will study that information and they will say, okay, you can get the grant. Whenever you get the money, you cannot use it to buy a car because you ask for a grant to continue your studies. So you have to use the money to continue studying. There are some other grants that you usually apply for as students, and those are grants for living. Because I'm going to study in Alcalá, but my parents live in Barcelona. So in order to continue my studies, I need an extra money to spend my time in Alcalá, to attend classes there, and so on. So this is, I think, the most similar situation I can find for you to understand. So what kind of grants can a company get? Well, depending on the use, there are two different ones. There are capital grants and operating grants. Capital grants are money that the company has to invest in assets. They have to buy a new machine, they have to buy a new building, they have to create an improvement, whatever. These capital grants are a collection. Whenever you put them in your chart, they are a collection when you receive the money, okay? If you don't receive the money, it's nothing yet. Then you have the operating grants. Operating grants is money that you have to invest in fabrication, in the productive department, okay? So you have to buy necessary things to produce. And these kind of grants are incomes and collections. So you put them there in your chart. On the other side, on the liability side, we have loans. What is a loan? Well, you need more money. You go to the bank and you say, hey, can I have some money from you? Maybe you don't go to the bank, you go to a financial company and you ask for the money again, okay? So the bank, the financial company, they give you the money and you have to give it back, okay? So whenever you ask for a loan, there are two situations. You get the loan, so that's a collection, and then you have to return the loan, and that's a payment. And those are the places where you have to put the loan in your chart. But when you get a loan, you always have to pay some interest. So whenever you have a loan, you have to reimburse the loan and pay some additional money, and this additional money is what we call the interest. In order to locate interest in our table, you need to know that whenever the company is getting a loan, this loan is always being used to produce. So if you need it to produce, it's going to be a cost. And since producing, the production department, is one of the usual activities of the company, it's always going to be an expense. And at some point, you have to pay this to the bank. So there's going to be a payment, an interest payment. In order to calculate interest, you have to remember that you calculate interest, the financial interest, over the outstanding loan. And check there's another video explaining in detail how to calculate the loan reimbursement, the financial interest for each year, and so on. Let's see all these concepts in the table. The first thing is the corporate capital cost. Remember, this is an opportunity cost. Since it's an opportunity cost, it's just a cost. You don't need to make any other question, okay? Remember, corporate capital cost, it's an opportunity cost, only a cost. Then we have grants, and there are two kinds of grants. We have capital grants and operating grants. Capital grants are just a collection. When the company receives the money, you just place that money in collections. Operating grants, however, are a little bit different because operating grants are devoted to production. That means there's a collection when you receive the money, but it's also an income because it's related to the usual activities of the company. Then we have loans. Loans are going to be a collection when you receive the money and a payment when you return the money of the loan. And finally, you have the financial interest. As we said just in the previous slide, loans are going to be used for producing. So the financial interest is going to be a cost because you need it to produce. It's going to be an expense because it's part of the usual activities of the company. It belongs to the production department, to the financial department. And it's also going to be a payment because you always have to pay the interest for your loans. I hope this helps to prepare the exercises and see you in the next video.